Today I'm going to share my 2026 investment plan. A new year means new goals, and I wanted to share them with you to take you along the journey with me. I'll also be reflecting on the plans and goals that I made in a video which I made last year, looking at the goals that I achieved, the ones I also didn't, and what I learned along the way. On top of that, I'll also be sharing 2 new exciting investments which I'll be making this year too. But first, I think it's important to give a little bit of context about my own personal circumstances. So for those of you who aren't aware, I'm 30 years of age. I'm a homeowner, I don't have any personal debt outside of a student loan and my mortgage. I also have emergency funds in place as well and cash buffers, along with I am a director of 2 limited companies, which is important for a little bit later on in the video. I feel like it's important to share this because perhaps it gives a little bit more of an insight into how and why I invest. But I guess more importantly, personal finance is of course personal to everybody. And hopefully what I've tried to demonstrate here is that my own personal circumstances, I've looked to get my own personal finances in order first. I've looked to try and build the right foundations, if you like, before I've looked to go on to invest any of my hard-earned money. Okay, now let's dive into my investment portfolio, and first I'll share with you one of 2 stocks and shares ISA accounts which I have, the first one being held with Trading 212. Now, one question that I see all the time is why would I look to invest my money when it's far more safer held in cash? And the answer to that question is that I'd actually be far worse off over the long term if I decided to hold all my money in cash. This chart from Schroders kind of explains a lot. It shows a simulation of the total value of cash ISAs in the UK from 2013 to 2023. Then it compares to what it would be worth if it had been invested into the global stock market instead. And you can see that UK households would have been £500 billion better off if they'd invested rather than held their money in a cash ISA, which is the equivalent to about 20% of UK GDP. That's a huge amount of wealth that we've left on the table as a nation. But for many people, holding on to cash feels safe. And without the kind of clear guidance and accessible investing education, it's very clear to understand why people decide to make that decision. And if I decided to do that, then there would be no way that this pot of money that I have over on Trading 212 would have grown 17.5% over the past 12 months if it was held in cash. Now, to achieve some of this portfolio value, in 2025 I set myself the personal goal to invest £833 per month, which is £10,000 or exactly half of my £20,000 ISA allowance. And I was able to achieve this goal investing roughly about £975 per month on average. And you can see that this was invested mainly in a Vanguard FTSE All World ETF. Now, this isn't an investment recommendation and isn't financial advice, and other funds are available. But this fund aims to track the performance of the FTSE All World Index, as you'd expect, which is made up of large and mid-sized company stocks in developed and emerging markets. Now, as I've kind of touched upon, one of the reasons why I invest in this way is because it outperforms, historically speaking, the rate of return on cash. But secondly is because it will also put me in the top 25% of stock market investors. And there's been lots of published research on this, but one piece which I recently found from AJ Bell, which was published in December 2025, shows that 25% of active fund managers, so these are the professional investment managers in Canary Wharf and over on Wall Street, only 25% of them actually outperform the global stock market. But get this, over a 5 and 10 year track record, only 13% managed to outperform the global stock market. For me, that shows if I just do the simple and the boring thing of buying into a low-cost, well-diversified or globally diversified exchange-traded fund, then I'll beat roughly 75 to 87% of professional fund managers based on this data. And I have no idea what's going to happen in the stock market this year. I have no idea which companies are going to perform the best. So because of that, this investment just makes the most sense for me personally. I don't have to read financial statements or keep on track of earnings reports, and I can take a pretty passive approach to my investments, which is what I like. Now, my goal this year is to eke out those contributions to my Trading 212 stock size, so just that little bit more this year. I'd love to be doing £1,200 a month if I can. It's certainly a tall order, but hopefully if the business keeps doing well and I'm able to pay myself well, then hopefully I will be able to achieve that amount throughout 2026. Now, to help you guys get started, Trading 212 have also kindly offered all of my subscribers one free fractional share valued up to £100 when you scan the QR code here or click on the link down in the description below and open an account, and all you need to do is deposit £1. Or alternatively, if you have got a Trading 212 account opened within the past 10 days, you can go into the app and enter the promo code Mitch, and you should still qualify for that one free fractional share. Okay, next up we have the second Stocks and Shares ISA account, which I hold with Vanguard. This is the account that I used when I very first started out investing nearly 9 years ago now, back in 2017, when I made my very first investment of £400. But let me be honest guys, this account has been dormant now for nearly 6 years, as I started investing on Trading 212 back in like 2020. Now I could do a portfolio transfer over onto Trading 212, but given that I've got my SIPP also held with Vanguard, which we'll touch upon shortly, then given that I've already got investments on the platform, I thought I'd just leave it all in one place. I do also plan to keep using Trading 212, so this account will just sit dormant for this year as well. Next up, we have my self-invested personal pension, which, as I've said, I hold with Vanguard. In 2024, I quit my full-time job to do this YouTube thing full-time, and as a result, I had to move my old workplace pension into essentially a private pension, which I now have to, or I've decided to, manage myself. Now, my pension is one of the most important investment vehicles for me for my retirement, and equally it's one of the most tax-advantaged places that I can put my money, as I said, because I'm a director of a limited company. The current rules state that I or my company can contribute up to £60,000 per tax year, or 100% of my income, and I get corporation tax relief on those contributions. So this could save me anywhere up to about £12,000 a year in corporation tax, which would be a huge saving. Now last year, I set myself the goal to invest £1,000 per month into my SIPP, and that was largely aligned with the contributions that me and my old employer were making back when I left my full-time job. I just kind of wanted to keep things consistent, and I was relatively happy with that amount. But it wasn't until I sat down with my accountant last year where he kind of said to me, Mitch, you should probably be putting a little bit more into your pension because you'll get a huge amount of tax advantages from doing so. So because of that, I did decide to up those pension contributions throughout the year. And over the last couple of months or so, I've been doing essentially the maximum contribution, or the equivalent to, by investing £5,000 per month. Although whilst doing this video, I did also realize from looking at the transactions that I also missed out contributions in June and September, so I haven't quite put as much into my pension as I thought that I did. Now I appreciate that this is a huge amount of money, but I guess I've got to kind of make hay whilst the sun shines and contribute as much to that pension pot as I can to accelerate the value of it, in order to hopefully use it to retire early at some point down the line. Now, as I've touched upon, my goal for this year is to contribute that full £60,000 into my SIPP, so about £5,000 a month. Of course, that's hugely dependent on the performance of the business, but let's just see how we go. Next up, we have investment property, and let me just say this one didn't go to plan. For anyone new to the channel, I already own one buy-to-let investment property, which I bought right the way back in 2023. And last year's plan was simple, and that was just to buy a second. And technically I did, well, kind of anyway. Essentially, I agreed a purchase of a 2-bed flat back in November 2024. But roll around to June 2025 and the purchase just wasn't moving forward. The seller's solicitors were just unresponsive, and then I also was hit with some unexpected health issues, which landed me up in hospital for a few days. And at the time, I was in a very difficult spot, and I decided to make the call to pull out of the deal. After getting over the initial shock of my health news and kind of using the last 6 months to rebuild myself, it's kind of given me a little bit of a new perspective on life, and also an opportunity to reframe things, in that whenever setbacks come along, then there's also opportunities for comebacks too. So in 2026, I'm going to be looking at getting that second buy-to-let investment property once again. I've actually got a viewing booked for this Thursday coming. It's a 2-bed terrace property that needs a bit of a renovation. Now, I likely won't jump in on the first one which I view, but it just gets me back on the horse, if you like, and I'll keep you guys updated on my property investment purchases through my weekly newsletter, which you can sign up to by clicking the QR code here on screen. Now, whilst all of this was happening, my existing property investment was ticking along all quite nicely, positively cash flowing about £600 per month, a reliable tenant, and no issues whatsoever. And that was until it wasn't, when I received this letter, unfortunately, at the back end of last year, which is from the property management company. And it says that there have been some changes to the service charges in association with the flat. It says the flat service charge is £14,791 for the year ahead, an increase of £976. Fine, kind of stomached that. It's a little bit extra, but not the end of the world. But then the next sentence is where the real kick in the teeth happened, because it then said that the flat's reserve fund is now £65,000, an increase of 50 grand. It says that they have allocated £65,000 to the reserve fund, which essentially is to contribute towards the full roof replacement works which have been identified in some kind of roof condition report as part of the 10-year maintenance plan. And there's no point me getting upset about this. It is what it is, but it is just one side of property investment that perhaps is less spoken about here on the internet. It's exactly why I kind of want to own multiple investment properties, because it means that if there's an issue with one property, it doesn't derail the whole strategy. And to be honest, I think in future I'll probably aim for freehold properties rather than leasehold properties, because at least upon the point of purchase, then there can be some deeper inspection which can be done on the condition of the roof and so on and so forth. This approach also spreads my risk across my broader investment portfolio, which, if I'm honest, is still largely geared towards the stock market. Of course, property isn't perfect, but it can be a little bit more of a stable asset class than perhaps equities are. As well, it can also provide me with a monthly income, which my stock investment portfolio, as of right now, certainly can't. Now, just thinking a little bit more about future-proofing my income, if I were to run some numbers on the fact that my current rental property rents out for £895 a month, and then potentially what I'm looking at in a new investment property could rent out for about £1,200 a month, assuming that these properties get paid off over the next 25 years or so when I come to retire, and that rental rates increase by a conservative 2% per year, then by retirement age that could give me an income of £3,450 per month in pre-tax income. Certainly not life-changing when we account for inflation, but it is an amount of money that could give me options, potentially even the option to retire earlier than I'd planned. Next up, we have my business investments, which I hold over on Lightyear. This was a new and unexpected investment for me to make in 2025, but it's one that I'll be continuing with in 2026. And that's investing some of my spare business cash over on the Lightyear investment platform. It's under their business account option, and essentially allows you to invest in all of the same kind of assets that you would be able to invest within a stock ISA, but just in this case, the business will own the assets. Now, I will say there are some rules around this, and I would always suggest going to speak to your accountant first if you're interested in doing something like this. But for me personally, I invest my spare business cash into something called a QMMF, which stands for a qualifying money market fund. It's a type of low-risk investment which is earning me a current rate of interest of 3.85%. Now, I use this account as a way of strategically outpacing the rate of inflation on my cash, because the rate of inflation is currently sat at 3.2%, along with because traditional banks like HSBC, who literally sent me an email whilst I was recording this video, that said that they were reducing my savings account rate to a pittance of 1.21%, which, to be honest, is an absolute joke considering the Bank of England base rate is 3.75%. That's a nice little profit margin that HSBC will be collecting for the cash that I hold with them. Now, I don't really have a goal set for this account in 2026. If I'm honest, some of this spare business cash may even be used to fund the property investment purchase at some point during the year. Oh, and I do also have a holding in a FTSE All-World ETF too, like I do with my SIPP and my stock ISA account. Again, the plans for this are fairly loose. I don't know if I'll add any more to it. It just depends on how the business performs and how much spare cash there is for me to invest that money. Moving on to the final investment that I'm going to be making in 2026, which is arguably one of the most exciting investments that I've ever had the opportunity to make, and that is in a junior stocks and shares ISA account. Me and my wife are expecting our first child in the early part of this year, and it gives me the opportunity as a first-time dad to invest a little bit of money for him, build up a little bit of an investment pot in order to give to him in an ever more expensive world, completely tax-free on his 18th birthday. Now, I can invest up to £9,000 per tax year for him into this account. Although, let me be straight, I'll probably be doing something like 50 quid a month as a starting point, because I've heard childcare is rather expensive. Although after 18 years of compounding, I still hope that he thinks I'm an absolute legend for investing that money for him. Just to kind of put that into perspective, if I were to invest £50 a month in something like a FTSE All-World fund, which has average returns over the past 20 years of just over 10% per year, and I were to do this and give him the money on his 18th birthday, then the amount that I would be handing over would be somewhere in the region of about £30,000. That money could help with university fees, a house deposit, or it could just give him options, providing he does something with it that's financially responsible and he doesn't go down to a club and buy bottle service with sparklers or whatever the kids do nowadays to be irresponsible. If there's one thing that life's taught me in the last year, all of this investing stuff is essentially there to give me time and options, because life can throw you some very unexpected curveballs when you very much least expect it, but the goal still remains the same, and that's to build options for my future. And all I'm trying to focus on is doing this for long enough that essentially time and market returns will do all of the heavy lifting for me. It doesn't matter whether you're investing £550 or £500 a month, progress comes from getting started and sticking with it even when things aren't perfect. Now, if you do want to get started, I've recently made a video of how to use Trading 2 on 2, which is the stocks and shares ISA account that I use. So be sure to click on that next. Be sure to subscribe to the channel to stay along on the journey. And with that said, I'll see you over in the next one.